Thank you so much for joining us today. My name is Matt Hilland. I'm a financial planner here at Arnold Remote Wealth Management. And this month we're looking at indexed insurance products. This is primarily indexed annuities and indexed universal life insurance. We see dozens of these products every year. The majority of people are reaching out to us because they're either unhappy with how they're performing or, quite honestly, just don't understand what they purchased years ago and want a second opinion on whether or not these products still make sense to have. And, despite a lot of the negative press that's out there on these products, hundreds of billions of dollars of these products are sold every single year. And so they're out there, they're being sold in force, and it's something that we just want to take a little bit of time to help you understand. And I think the best place to start is just by looking at an example. Here I'm showing you some marketing material from about 20 years ago from Allianz Indexed Annuity. This is from a series called the Master Dex 10, and I just want to highlight some of the main talking points that I imagined a salesperson of this product stressed, as part of the sales process. The safety of these products is going to be a really big talking point and a really big sales point. No one likes to see their investments go down, right? So wouldn't you love a product that can never cause losses due to market volatility? And not only can it not lose value, but you may also be able to receive 100% of the market growth through 100% participation of gains in the index. So you get the upside, you're protected on the downside. Sounds like the perfect investment, right? Well, it turns out it's actually pretty far from that. But before I go any more, I want to share this just so you don't think I'm picking some obscure or very bad annuity product here on purpose. On this slide, I'm showing you a press release from early 2006 from a company called Beacon Research, just highlighting that this annuity that I'm showing you here was the best-selling annuity in the fourth quarter of 2005 and had been for quite a while, actually. And so again, we're talking tens or hundreds of billions of dollars a year in products that are just like this one that we're going to look at. And so now let's take a look at that exact annuity and how it performed over a certain period. On this slide, I'm showing you how the S&P 500 index performed from May 2023 to May 2024. You can see from the chart here that the index, including dividends, was up a little bit more than 22% over that time frame. Now remember that annuity we were just looking at had a 100% participation rate is what it was marketing there. And I'm showing here that it is allocated 100% to the S&P 500 index as part of a choice that this annuity owner made when they purchased the annuity. And my question for you is, what return should this annuity have had over this time period? And how surprising is it to you that this annuity returned exactly 0% over that time period? Despite being 100% linked to the S&P 500 index, what you may not have seen in the fine print of the annuity is something called a monthly cap rate. And here I'm highlighting a section from the annuity contract showing that this product has what's called a 1% monthly cap rate. And what this means, I think, is pretty self-explanatory. The most this annuity can increase in any one month is 1%. And so this table on the right shows month by month how the annuity performed compared to the S&P 500 index. And so just for example, you can see in month one, the S&P was up about 4.89%. But the monthly cap of 1% meant that this annuity was only credited 1% for that month instead. Then you look at further months and you see something potentially even worse. Well, gains are capped, and that's certainly problematic for the investor. You also receive 100% of the downside in the month. So look at month three here. The S&P 500 fell 2.2% that month. You lose 2.2% on your credits, on your gains for this annuity for the year. Then this process continues for all 12 months. And at the end, you can see the annuity simply sums up the those cap monthly rates, that right-hand column, which in this case sum to negative 2.33. Since that's a negative number, this annuity does you the great favor of only giving you a 0% return because that is guaranteed as part of this annuity. Remember, you don't experience downside, so you can't lose money, but you earn zero when even though the underlying index of this annuity is up 22%. Now I want to take a look at a different annuity, and this time we're going to focus not on just a short term, but on the long-term impact of holding these annuities for decades. This annuity is from Equitrust. It's called the Market 12 Bonus Index. Here again, I'm showing you some of the marketing material from this from 2013. And you can see it's stressing the same types of things, only getting the gains, not losses, only getting upside, none of the downside, locking in S&P 500 index gains while avoiding losses when the index declines. Same exact talking points that we just saw. And so now instead of 1 year performance, I'm going to look at how this annuity performed over a 10-year period. Let's say the salesperson did such a good job here that they convinced you to move $400,000 into this product in March of 2013. Again, you know from the marketing material that the performance of this annuity is tied to the S&P 500 index. So here I'm showing you how the S&P 500 index did over the next 10 years. On the chart on the left, you can see the index, including dividends, was up about 217% over that time period. The chart on the right is showing you that a $400,000 investment in March of 2013 was worth about $1.2 million 10 years later. And I should say too, this is not just a hypothetical example. This is an exact annuity and numbers for a client that we worked with that wanted help investigating this annuity purchase because they were, we'll see here in a second, why they were not unhappy with how this performed 10 years later. And so again, my question to you is how much should this annuity have returned over the 10-year period? Well, we can go back and see what the capped rates were for every year of the policy. These caps can change, as you can see here. And so even if you think you are doing all your due diligence, you recognize what the cap rate is, and you think you're getting a good cap rate when you purchase these products, there's no guarantee that that cap stays in place. If interest rates fall or market volatility changes, these insurance companies can change their cap rates to ensure that they remain profitable. And so just shown here is how that cap rate can or did in this case change year over year for just a few years of the policy. This is information you'll want to track down if you're reviewing your own policy and trying to compare or see how it did over the long term. And then we do the same exercise we did with that first annuity, but now for 10 different years. And we start to see exactly how this product works and how limiting and how damaging those monthly caps are in the long term. What I want to highlight is this table in the top right here. I'm showing how the annuity performed in a few key years. That's the middle column in the table here. And then how the S&P 500 index performed in the right table. To be clear, there are years where this annuity outperformed the S&P 500 index. The 2019 year that we show here is a clear example of this. This is when the COVID crisis hit. The S&P 500 was down. This annuity would have protected you from that decline. But what is really much more damaging to your long-term returns is that you get no upside or very little upside at all. And so look at the following contract year, right? When the S&P 500 really rebounded after the COVID crisis. Again, this is not calendar year, this is contract year here, but over the 12 months, from March of 2020 to February of 2021, the S&P 500 index was up 52.3%. This annuity gained 0.3% over that period. And so you do save yourself on losses potentially, but you give up a lot of gains by using these types of investments for long-term savings. And ultimately, what we find that after 10 years, this $400,000 investment was worth under $500,000 10 years later, about $497,000, a total return of 24.4%, or maybe put another way, it averaged about a 2.2% per year compounded return. Now, of course, this vastly underperformed the S&P 500. It also vastly underperformed a basic 60-40, 60% stocks, 40% bonds investment portfolio, which I'm measuring here just by using the performance of the Vanguard Balanced Admiral Mutual Fund. It's a mutual fund, just a very cheap way to invest in a very basic 60-40 portfolio. And what this annuity, which is, remember, being marketed as being tied to the S&P 500, remember, most closely resembles, seems to be more of a bond fund. A $400,000 investment in the aggregate bond index would have returned about 443,000 over that same time period, and that's with 2022 being literally the worst year for bonds in the last 100 years, occurring right at the end there. This basic bond fund was outperforming this indexed annuity for 9 out of the 10 years. And so, even something very simple like a money market is, not really that far behind over a 10-year period, especially considering interest rates were near zero for half of this time period. So hopefully this is helpful to see. At the very least, realize that these products are anything but stock market investments. And then there's another index product that I mentioned in our newsletter we would discuss as well here. This will be a much shorter discussion because a lot of the points are very similar, but I wanted to touch on index universal life insurance as well. This operates on a very similar principle. You have this investment that is somehow tied to the stock market, and there are some sort of caps and protections in place. And so in this case, there's also added expenses and fees as well. And these are much more complicated than the indexed annuities we just looked at, but you can get all the numbers to determine how these products could potentially perform. When you shop for these products, you'll receive very big packets, including large tables of data like we're showing here. And they tend to highlight how these investments could perform in different return assumptions. And just for example, this one here is showing an implied return of about 6.5% per year for the next 40 plus years. And it's trying to show you that, yep, if you get that 6.5% return for 40 years, the value of this product is going to increase substantially, as shown in these far right columns here. But you need to ask yourself, or better yet, ask the salesperson, how likely is it that you actually get that 6.5% return? If you're on a 1% monthly cap, it's probably very rarely going to happen, as we just showed with looking at that last annuity. Maybe you get more advantageous crediting, maybe it's a higher cap, maybe it's a yearly cap instead of monthly, but you have to understand how your returns are being calculated to know whether or not these results are even realistic at all. Because you'll also see in very big writing on all these, all of the numbers they're going to show you are non-guaranteed, or at least all the numbers that look really good are non-guaranteed. And it just so happens that this news article hit the press just as I was getting this webinar ready. And so I thought that this would serve as a better example of the dangers of these policies than just another, example from me. So this is a story, Kyle Busch, one of the more famous NASCAR drivers today, just went public that they lost more than $8 million in these indexed universal life insurance policies. So not only do they just not gain, recognize here that they put in more than $10 million and lost more than $8 million in these products. And so our criticism before of indexed annuities was that they just don't gain very much money. Here, this is much more serious. We're talking about actually losing a significant amount of your money in these products, and that it is possible and it happens to very wealthy people who, you would assume can get very good advice here if they if they were in touch with the right people. And so because these products have very real risks, that quite honestly, even a fixed index annuity doesn't have, you need to heavily scrutinize these products before you make a purchase. And besides just how the calculations work for gains or crediting for the growth of your investments here, there's a couple other important things to know about these products. First, they're going to have surrender periods. This is a fee that you pay back to the insurance company if you ask to get your money back before a set period of time. And very often, these are very, very long-term periods. And so shown here is the surrender fees for that Master Dex annuity, the first annuity that we looked at. Even 10 years in, if you want to get your money back, you pay back 10% of you pay a 10% penalty. These surrender fees typically last somewhere between 7 and 15 years, depending on the insurance company. We have seen some of them go to 20 years. And so that may very well mean that you need to keep your money in these products for 5 or 10 years just to break even. Because remember, they are not going to grow substantially. You start talking about 2% per year in growth. Even 5 or 10 years in, when you're having to pay 20 or 10% penalties, it's going to take a majority of those gains back just to pay that penalty. And another big trade-off you need to recognize with these is that you're potentially increasing future tax liability with these products. These products are always sold with some benefit of tax deferral, right? The gains that you get, the interest you receive from these products every year is not taxed every single year. But what kind of gets hidden here or just not realized is that when you finally ask to get your money out of these products, all the gains are taxed as income. And so while tax deferral can or may very well be beneficial in those early years, you just need to make sure that it's worth it in the long run because simple investments like a brokerage account tend to get favorable long-term tax treatment with long-term capital gains tax rates instead of income tax rates. And so again, this is not necessarily something that's bad for everyone. There can be very valid reasons to have tax deferral. You just need to make sure it's worth the cost for you. And ultimately, we don't recommend these products because we just find that there are better options for just about every scenario. For short term, if you are concerned about some amount of money not falling in value over a short-term period, that's very rational. You should absolutely not use the S&P 500 for savings for a car you need to buy next year or a future home down payment or, maybe your next 12 months of expenses. But these products are not a good substitute for that. As we saw, primarily it's because they have very significant surrender fees that really are designed to only make them suitable for long-term savings. But then over the long term, the caps and fees on these products make it almost impossible to match the long-term return of a diversified, investment portfolio. And so, what are some better options? As with a lot of products out there, it seldom pays to combine insurance elements with your investments. If you need money set aside for the short term or for the money you should have set aside for the short term, use the wide variety of low cost, even potentially government guaranteed saving options that are out there. Money markets, CDs, treasury bonds are all glanced over because they are so simple, but for 99% of the people can be more effective, can be more tax efficient than some of these other products that are out there. For a little bit longer term, we've done longer term savings. We've done a webinar in the past on those defined maturity bond funds. That can be a really good way to kind of bucket out money that you need in the short term, not have to worry about stock market volatility. That's another really good option to consider. And I'll just say too that we looked at those past few examples, and some of these short-term savings options we're including here come very close to outperforming some of these annuities, if they're held for a decade or more anyway. And so, something that I think is interesting is that 4% you can get on a treasury bill today may very well outperform these index annuities anyway. So, but really for long-term investments, that diversified mix of stocks and bonds is just really hard to beat. Diversify more, add more bonds if market volatility is really scaring you. Use short-term bonds to dampen that volatility as you need, but don't get sold these products based on the fear that the market might go down. Because, news for you, the market does go down, and that's okay. Bucketing some short-term money set aside, like we show above there, is very smart. That allows you to handle the volatility for those longer term investments. Because at the very least, you need to understand that the trade-off for not experiencing any downside with your investments is that you also rarely experience any upside. And so that alone has some very real risks. If your money is not growing, if it's not keeping up with inflation, you are losing money in a real sense. And so these products are designed to look at very short-term protection from market movements, but in the long run can very much, cost you in a real sense. And the same goes with life insurance. These index products really don't solve any problem. You probably won't need life insurance for the entire time you're alive. If you're like most, you need insurance in your younger years to protect your future income, maybe help protect your surviving spouse from a mortgage, pay for some kids' education costs. Don't pay an arm and a leg for things like index universal life insurance that are designed to give you big death benefits, up into your 90s or even if you live to 100. Very cheap term insurance will be able to provide you with an order of magnitude more protection at a fraction of the cost. And if you truly do need some sort of permanent life insurance option, look at guaranteed options. Something like a guaranteed universal life will at least be very clear in how much you need to pay to receive a guaranteed benefit at death. Even whole life has a little bit better guarantees and returns than some of this that, could make it a better option, I guess. But again, don't get tricked into thinking there's some advantage or secret formula here for combining insurance products with your investments. It's very rarely worth it. And finally, I just want to look back at either the fixed index annuities or some of the index universal life insurance on one other feature that is very commonly sold with this. And this is talking about producing retirement income for you. So at some date in the future, you can take the value of these policies and annuitize them or turn them into monthly income that will last for the rest of your life. And the one thing I want to be clear on is that you do not have to save into these products for a long time in order to get an annuity. You can buy an annuity at any day, any time. You do not need to buy and save into these products now for the anticipation of needing income later. Don't let them, make that any part of the sales process. You can save in your 401k or an IRA for 60 years of your life. And when you retire, if you decide you want some amount of guaranteed income, then you can buy an annuity. You don't need to get in, 40 years ahead and try to save into the annuities for that. If you're interested more in this kind of retirement income aspect, we have another webinar that we've done. The title is The Only Annuities We Would Recommend, that looks at a couple products that are good for this use. It's a very valid reason to want to use an annuity. But again, there's good options and there's bad options. And these indexed annuities are not a good option for producing that guaranteed retirement income that a lot of people look for. All right, that's it for now. Thanks so much for listening. Happy Halloween for those of you that are watching live here. Have a good night and hope you have fun. If you have any questions, please don't be afraid to reach out here. My email, phone numbers there on the slide. Let us know any feedback or questions that you have, or if you have one of these policies that we can help review and figure out the best path forward for you. So if that's it, have a good one. Thanks so much. Take care.